Chapter 2, Currency Pairs. Section 1, Base versus Quote Currency. In Forex, you never trade a single currency by itself. Every price is a comparison between two currencies, and the order matters. The first currency is the base, and the second is the quote. So if you see Euro/USD, the market is telling you the price of 1 euro in US dollars. A Forex quote tells you how much of the quote currency it takes to buy 1 unit of the base currency. So Euro/USD at 1.1000 means 1 euro costs 1.1000 US dollars, while USD/JPY at 110 means 1 US dollar costs 110 yen. The key is to read it in that direction, not backward. Once you know which currency is the base, trade direction becomes much easier to understand. Buying a pair means you're buying the base currency and selling the quote. So you do that if you expect the base to strengthen. Selling a pair is the opposite. You're selling the base because you expect it to weaken relative to the quote. That same logic works no matter which pair you're looking at. If you think the base currency will rise against the quote, you buy. If you think the base will fall, you sell. So with GBP/USD, the question is really whether the pound will strengthen or weaken versus the dollar. The base currency also shows up in your position size. Trade size is measured in units of the base. So if you trade 1,000 units of GBP/USD, you're trading 1,000 pounds, not 1,000 dollars. The value of that position in the quote currency changes with the current exchange rate. When the price moves, profit or loss is first calculated in the quote currency. That means Euros/USD produces profit or loss in US dollars, and USD/JPY produces it in yen. If your trading account is in a different currency, that amount then has to be converted. PIP value follows the same pattern. It's tied to the pair, and it's first expressed in the quote currency. For most pairs, 1 pip is 0.0001, but for most yen pairs, 1 pip is 0.01. That's why a standard lot in Euros/USD is often about 10 US dollars per pip, while USD/JPY is about 100 yen per pip. Let's make it concrete with a trade in GBP/USD. Alice has a US dollar account and buys 1,000 pounds at 1,000 T3 cents because she expects the pound to strengthen. At entry, that position is worth 1,300 US dollars, and if GBP/USD rises to 1,035 bows, are worth $1,305. From there, calculating profit is straightforward. You take the exit value, 1,305 US dollars, and subtract the entry value, 1,300 US dollars, which leaves a profit of $5. Because Alice's account is already in US dollars, no conversion is needed. A few quick checks can save you from very common mistakes. Don't reverse the pair order, don't read the quote backward, and remember that buying means buying the base currency. It also helps to pause and check whether it's a yen pair, since pip conventions differ, and whether profit or loss needs conversion into your account currency.